Welcome back, everyone. Today we are shifting from supply and demand model into the foundations of monetary system, money and the banking system. Understanding what money is, why it exists, and how banks function is essential for understanding inflation, monetary policy, and financial markets later in this course. Before money existed, people relied on a barter system, meaning they traded goods directly for other goods. But barter is, extremely inefficient. The biggest problem is the double coincidence of wants. To trade with someone, you must find a person who not only has what you want, but also wants exactly what you have. For example, if you want a pair of shoes and you can offer tax preparation skills, you need to find exactly a shoemaker who also needs tax help. That's unlikely. As economies grow, this system becomes impossible to maintain because thousands of goods and services exist. Barter also struggles with the future contract. It's hard to agree on future payments when everything is traded in goods. Money solves all of these problems. Money plays four essential functions in the economy. First is medium of exchange. Money acts as the middle step in transactions. Buyers and sellers no longer need to match wants. Money is universally accepted. Second is store of value. Money holds purchasing power over time. It allows you to save now and spend later. However, in periods of high inflation, money becomes a poor store of value. Third is unit of account. Money provides a standard way to measure and compare value. Prices, wages, and debts all use the same yardstick. Fourth is standard of deferred payment. Money can be used for future payments like loan repayment or contract. Together, these functions make money essential for modern economic activity. Historically, different types of money have been used. Commodity money is the money that has value even when not used as money. Examples include gold, silver, salt, and shells. Commodity-backed money is the paper money that is backed by a commodity stored in government vault. You could at one time exchange the paper for a fixed amount of gold or silver. Fiat money is today's money. Fiat money has no intrinsic value. Its value comes from government declaration and public trust. It is legal tender because the government says it is. Modern economic systems rely heavily on trust and stability to maintain the value of fiat money. Let's briefly look at how the US transitioned to fiat money. After World War II, the US dollar became the world reserve currency pegged to gold at $35 per ounce. However, in the 1960s, the US printed more dollars than its stocks of gold could support due to spending on the Vietnam War and domestic social programs. Foreign countries lost confidence and began, exchanging their dollars for goods at a rapid pace. In 1971, President Richard Nixon announced that the US would suspend the conversion of dollars into gold. This decision, known as the Nixon shock, effectively ended the gold standard. From that moment, the US dollar became a pure fiat money system. To analyze the money supply, economists distinguished between different categories of the money based on liquidity, which is how easily an asset can be converted into cash. Two main categories are first one is M1, which is the most liquid. It includes the most spendable forms of money, currency, and checking deposit. Second one is M2, which is less liquid but still part of money supply. It includes everything in M1 plus saving account, money market funds, and certificate of deposit. These measures help policymakers and economists understand the availability of money in the economy and predict consumer spending and inflation. M1 includes the most liquid types of money, such as coins and currency in circulation, checkable deposit, traveler's checks. M1 is essentially the money we can spend immediately. M2 includes everything in M1 plus less liquid assets such as saving deposit, money market funds, and certificate of deposit and time deposit. M1 provides a broader measure of the money available in financial system. Many people confuse method of payment with money itself. Debit cards do not create money. They simply transfer existing deposits. Credit cards are not money. They are short-term loans from credit card companies. Smart cards like prepaid campus cards or gift cards store values but are limited in use. The important takeaway is that money is the deposit in the bank, not the plastic card used to access it. Banks play a crucial role in the economy by reducing transaction costs, which are the costs of finding a borrowers or lenders on your own. Banks offer several services such as a safe place to store money, the ability to make electronic payment, access to loans for household and businesses, and central position in the payment system. Without banks, financial transaction would be slower, riskier, and far more costly. Banks serve as financial intermediaries, connecting savers and borrowers. Here's how it works. Savers deposit money in banks and receive interest. Borrowers take loans and pay interest to banks. And then banks use borrowers' interest payments to pay savers and operate profitably. This intermediary role is essential. Without it, many people would struggle to find reliable partners for lending or borrowing. A depository institution is any institution that accepts deposit and use those funds to make loans. There are three major types. Commercial banks are the most common type used for everyday banking, deposits, and loans. Saving institutions historically specialized in mortgage lending and home financing. Credit unions are non-profit, member-owned institutions that serve specific communities and offer loans, saving, and other banking services. Understanding these institutions is the key to understand the modern financial system. Thank you for your attention.